Let's be real, everyone wants to be a millionaire, but most people are terrified that they've already missed the boat. But is it really too late for you? My name's Tomo, I'm an accountant, and in this video, I'm going to break down the exact math for each age bracket to hit that 7-figure mark. I'm not just going to give you a spreadsheet though. What I'm also going to do is help you find extra money in your budget at each age bracket to make these numbers a reality. If you're in your 20s, you have something more valuable than a high salary: time. Whether you're just finishing university or you've been on the tools of a trade for a few years, this is your golden era. Your responsibilities are likely at their lowest, however your compounding potential is at its absolute peak. Now check this, assuming a 9% annual rate of return, which is the long run return of the Australian stock market, a 20-year-old would only need to invest $40 a week to become a millionaire by age 65, so in 45 years. That's only a couple of nights of Uber Eats. Now, if waiting till you're 65 seems far too long for you, let's have a look at what happens if you double the weekly investment to $80 a week. Logically, you expect to hit your goal in half the time, right? Wrong. Compounding is exponential, which means the longer the time that you have in the market, the more the gains flow to you in those later years. Doubling your investment shaves off about 8 years to become a millionaire, so you hit it by about age 57. It shows you that in your 20s, time does more of the heavy lifting than cash. We'll look at some larger weekly investment amounts and how quickly this makes you a millionaire later on in the video. Now, if you don't think you can find $40 to $80 a week, if that seems like it would be a bit of a stretch for you, a good way to think about it is a convenience tax. Trading some convenient items now to become a millionaire later on. One Uber Eats meal can easily cost triple what a home cooked meal cost. Sacrificing one delivery per week quite literally puts you on the path to becoming a millionaire. Now, if you're in your 30s, life probably looks a little bit different to you. You might have a mortgage, a couple of kids, and you have a lot more month at the end of your money. But here's the kicker. Because you missed those first 10 years of compounding, the price of admission to the Millionaires Club just went up. Now, remember how a 20-year-old needed to invest $40 per week to hit that $1 million status by age 65? Well, a 30-year-old needs to invest $100 per week to hit that millionaire status at the same time. That's more than double the effort of a 20-year-old for the exact same result. Think of it as a $60 procrastination tax that you're paying every single week. Let's do the double again. So if you're a 30-year-old and you invest $200 a week, how long would it take you to hit that $1 million? And the answer is it would take you 27 years. So again, it shaves about 8 years off your investment term, which puts you at that $1 million at age 57. Now, if you were a 20-year-old investing $200 a week, how long would it take you to hit that $1 million? And the answer is you would hit it by age about 47, which shaves 18 years off our initial example. Time is a wonderful thing in compounding wealth. So where can you find an extra $100 a week when you have a mortgage? Well, when you're in your 30s, a lot of it comes down to shopping around and negotiation. Let's first talk about the mortgage hack. In Australia, even a small decrease on your interest rate via refinancing or shopping around for a better rate can quite literally save you hundreds of dollars a month. Another one is insurance. Quite recently, I rang up my insurer asking for a better deal, and I was able to save $400 a year just by asking. I did a video on that, so I'll leave a link in the description. And don't forget your electricity and utilities. So across your mortgage, your insurance, and your utilities, shopping around for the best deal can quite easily save you thousands of dollars a year. Now, if $100 per week in your 30s felt like a real jump, well, your 40s is where the math gets real. And this is the decade where people panic, thinking that they've missed the boat entirely. But is it actually too late? Let's look at some of the numbers for a 40-year-old and why your peak earning years are your secret weapon. To hit that $1 million goal by age 65, your weekly investment amount jumps to $240. And while that sounds like a massive leap from the $40 we saw earlier, don't hit the panic button just yet. In your 40s, you normally have more financial muscle. You've hit your peak earning years and you're well past the entry-level wages of your 20s. Now, if you doubled that weekly investment to $480 per week, then it would take you roughly 18 years to hit that $1 million target, so about age 58. So where can you find extra money at the age of 40? Well, these are your peak earning years. You should be past the entry-level wages of your 20s, so hopefully you're finding that you have more leftover cash each payday. Another thing to consider is some tax maneuvering. Now, I'm not a licensed financial advisor, so make sure you seek some professional assistance. But by this stage of life, you've likely built up some equity in your home. Now, the repayments that you make on the home that you live in are non-tax deductible. However, the interest that you pay perhaps on an investment loan is tax deductible. One possible option that you can consider is doing some debt recycling. And simply what that is borrowing against your personal home to make other investments in assets. It's converting non-deductible interest on your personal home to deductible interest on an investment loan. But make sure you seek professional advice around this. Another thing to consider is lifestyle reset. A lot of people in their 40s experience lifestyle creep. So if you get a large pay rise at work or a bonus, don't upgrade the car. Instead, redirect that extra income into investments. The math is harder, but the goal is still very much in reach. You still have 25 years of compounding magic left, which is more than enough time to build a life-changing nest egg today. And if, after all the scrimping and saving, you don't quite hit these weekly investment targets, that's not a reason to do nothing. Even if you invest less or start smaller, you can still build a really healthy investment portfolio. And even if it's not $1 million, you'll be in a much better financial position than if you did nothing at all. Some other really important things to consider. We used a 9% annual return because that is the long run return of the Australian stock market. Now, there's another thing that Australian companies that are really good at, and that is paying dividends. So one strategy you can also adopt is using these dividends and reinvesting them into more shares, and that will help you build to your goal much faster. I've done a video on dividend investing, which I'll leave a link in the description below. And right now the question may come to you, what should I invest in? I've also done a video on that, which can really help beginner investors, which I'll leave a link in the description as well. It's never too late to start investing, and my hope is that this video has provided you some motivation to get started today. If you enjoyed the video, please hit the like button or share it with a friend. And if you'd like to see more from me, please consider subscribing. Now, please keep in mind, I'm not a licensed financial advisor. This video is for educational and entertainment purposes only.